You look at the LBMA, David Jensen, one of the best that there is, he says that London has 2 billion ounces in outstanding spot contracts that have standing behind it 140 million ounces. What could possibly go wrong if everyone stands for delivery? 2 billion into a window of 140 million. That's a problem. To me, all I look at is the most well-informed traders. Since I started talking with you, it was the central banks, and now it's progressed to whoever the hell is doing it here in the United States at a level no one's ever seen before.
I think we could easily see silver being squeezed up even further, but not producing sellers. If anything, producing buyers on the squeeze. In other words, the squeeze is not over. It's got quite a way to go.
The London Bullion Market Association, LBMA, is sitting on a powder keg of unbacked paper leverage, with analyst data revealing 2 billion ounces of outstanding spot contracts, supported by a trivial 140 million ounces of physical metal. This staggering imbalance creates structural fragility, in which even a minor uptick in delivery demand could drain the vault, triggering a systemic default. AndySchectman, president of Miles Franklin, and Alasdair Macleod, head of research at Goldmoney, break down this critical risk. This dynamic is being exacerbated by the most informed traders, central banks, and elite investors, who are accelerating purchases regardless of price. Unlike typical market cycles, in which high prices induce selling, the current rally is generating a buy-the-squeeze psychology. The market is entering a phase where rising prices confirm the shortage, ensuring the squeeze has significantly further to run before proper physical equilibrium is reached. Now, we present the clips from AndySchectman and Alasdair Macleod's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The highest level in December, we saw 65 million ounces or so delivered off the COMEX or onto the COMEX. Who's buying that? A mint box of Silver Eagles is 500 ounces, weighs 42 pounds. Who's buying 65 million ounces? But it's been between 40 and 60 plus million ounces every darn month for the last 15, 16 months. Who's doing that? And, you look at the LBMA, David Jensen, one of the best that there is, he says that London has 2 billion ounces in outstanding spot contracts that have standing behind it 140 million ounces. What could possibly go wrong if everyone stands for delivery? 2 billion into a window of 140 million. That's a problem. But when you look at what's happening here in the United States on a retail market, it's very, very, very confusing market. Largely because the price is moving up so fast the cost of maintaining positions is moving up so fast. Let me put it this way. We hedge every ounce we have. We will typically have between 2 and 3 million ounces of silver in our warehouse. To hedge one 5,000 ounce silver COMEX contract, you need to have over $40,000 in your margin account. On Christmas Day, it was 21,000. And so not only are the margin rates going higher, which shakes the weak hands off the tree. Let's look at December. They raised it twice in 2 weeks, before and after Christmas. So the day Christmas, 21,000, the next day, 27,000 in your margin account. Now it's over 40. But if you are someone with a bunch of money in your margin account and you have a bunch of contracts, you're trying to take advantage of this silver run, and all of a sudden they raise the margins on you by 30% on the day after Christmas, and if you don't pay, we liquidate. Well, a lot of people are forced to liquidate to cover their margin on the other contracts or whatnot, which selling begets selling begets selling. Now in 2011, that killed the rally. That's what they did to stop the rally. They raised margin a bunch. This time, what happens? Oh, it's the largest delivery in the history of the COMEX for the December contract, because the people that are standing for delivery, they don't use margin. They don't care. It's a subsidy to them. Thank you very much, they say. Scoop it up and stand for delivery. So things are changing, but I will tell you, like refineries, they're not taking any business right now because it's taking them so long to purify and produce. And they have to hedge their position too. So if they have 30 million in work, it takes weeks to get it fully produced from scrap or junk silver or doré or whatever to the refined product. It takes a while, but the price is moving up so fast that their hedge book, so if you have 30 million, you have to sell 30 million on COMEX. So if the price of your 30 million in inventory drops by, $10, you're not out enough to put you out of business. So instead, you short the exact same amount. You remain market neutral. Problem is, silver's moving up so fast and the rate hikes are moving up that they're getting margin called. So the refiners aren't taking anything. The big companies like myself, and even the bigger ones who try to hedge, if you have 3 million ounces and it costs $41,000 to hedge 5,000 ounces, the cost, you have to have millions and millions and millions of dollars in your margin account just to maintain a hedge position. It's a crazy environment right now. Kai, I've never seen anything like it, but to me, all I look at is the most well-informed traders. Since I started talking with you, it was the central banks, and now it's progressed to whoever the hell is doing it here in the United States at a level no one's ever seen before. It does. Well, I mean, look what the U.S. government did after all of these imports. What do? Oh, that's right. Silver's a critical mineral. Oh, that's right. We are now putting a floor underneath it. Within the next 90 days, a state-sponsored floor underneath all the critical minerals. Why? To incentivize domestic mining. If silver is found in a form called epithermal, like your skin is epidermis near the top, big deposits were found forever ago. So you got to dig further. Most of it comes from byproduct of copper, lead, and zinc. You got to dig further, look more. Well, the all-in sustaining cost at that level is probably $40. So if you put a price floor high enough underneath it, you will incentivize domestic mining. And now they just came out and are proposing a strategic stockpile. So you can see these things are happening, but the thing is that the mainstream doesn't get this, doesn't talk about it. You got to listen to people, conspiracy theorists like you and I, right? Or are we? Or are we maybe just seeing things a little bit more clearly than the masses?
I think we got.
It's really big industries who have, if you like, relied on deliveries out of the market for their silver, are suddenly finding there's none there. And for some time, they've been buying, let's say, futures with an idea of just taking delivery on expiry. Or in London, buying forward contracts and, again, insisting on delivery rather than cancelling out another position by selling the forward contract into the market. So this has come as a bit of a crisis. And it's come at an interesting juncture because, again, China is very much involved in this. China has brought in a new licensing regime for silver exports. Now, the information that we have is that so far this hasn't really kicked in too much. But you can see that the objective of this is to give China, if you like, greater control over something which, as a nation, they feel they really do need. Silver is so important.
Yes.
China is something like the second largest miner, second or third largest miner. As well as that, for decades, she's been importing doré and refining that into silver and hoarding the silver. So she has got undeclared stocks which are substantial. Of that, I have absolutely no doubt. I mean, it's circumstantial evidence. But on the other hand, you just, join the dots and you can see that this is the case. I think the price exploded upwards, really, on the back of Donald Trump's trying to tariff China, which led to China saying, okay, that's your game. You're not getting any rare earths. So that was the first thing. And of course, silver is a much needed commodity, which it's not a rare earth, but in that definition, but it's not that common. So it's something which it's more in China's interest to hold on to now than to supply into the market in order to keep prices low, so that her industrial entities making photovoltaics, making electric cars and all the rest of it, sort of are competitive. That is no longer the situation. And it happened at a time when Indian demand has taken off because the Indian government, which, while it's been sort of building, coal-fired power stations and doing all these horrid things, has been, if you like, offsetting it to a degree by encouraging major corporations like Reliance Industries to make photovoltaic cells. And they've been subsidized to an extent to do it. So, the investment that Reliance Industries, and I'm sure there are others, have made in production are just absolutely astronomical. But where do they get the silver? And I think that they have been one of the gangs, if you like, that have been standing for delivery in financial markets. It's a fascinating situation, and it's a problem that is not going away. And I think, we could easily see silver being squeezed up even further, but not producing sellers. If anything, producing buyers on the squeeze. In other words, the squeeze is not over. It's got quite a way to go.
A fundamental break in market mechanics has occurred on the COMEX. Historically, exchange officials dampened rallies by raising margin requirements, forcing leveraged speculators to liquidate. Today, however, these hikes are being ignored by well-capitalized industrial buyers who are standing ready to take delivery of up to 65 million ounces a month. This signals that the buyers are not seeking paper profits, but are desperate for physical feedstock to maintain industrial operations. Global competition for critical minerals is intensifying, with China implementing export controls and Indian conglomerates aggressively securing photovoltaic supply. The market is witnessing a squeeze-up. In this scenario, rising prices do not induce selling. Instead, they trigger panic buying as nations and corporations race to build strategic stockpiles before the window closes. The U.S. government's move to designate silver a critical mineral and propose price floors confirms that this is no longer a trade but a matter of national security. Let's get back to the interview.
Less than 1% of contracts on COMEX or LBMA really ever stood for delivery. Now it's a lot. Huge amounts. Record month after record month after record month after record month for the last 16 months since Trump won the election. It's telling me that gold and silver are finally beginning to slowly find real price discovery, which they've never been allowed to find, ever. Going all the way back to the London gold pool. Never found price discovery. It's starting to happen because delivery is overwhelming the ability to suppress with paper. That's just the bottom line. The dollar was always the beacon of trust, and the dollar isn't trusted anymore, nor are our institutions, nor is the system trusted. And I think gold and silver are reflecting that through delivery. The biggest, most well-informed players in the world continue to stand for delivery at a level no one has ever seen. And the retail public wouldn't know a gold coin if it fell on their foot. So no, this is far from a bubble. If this room was filled with people that have never been to a place like this, ever, then I might agree with that. But the retail public has no idea yet.
The consequence of fiat currencies has been to suppress the real value of base metals, the metals used in industry. Now, copper is another example. You see how the copper price has behaved. It has actually risen quite sharply. Obviously not as much as silver and some of the platinum group metals, but nonetheless, if you look at the value of these base metals in gold, then you can see that the price of a basket, if you like, has fallen by roughly 80% from that long-term average. Now, monetary theory tells us that actually the purchasing power of gold is stable over long periods of time. So with it, with everything else, all the other base metals being 20%, if you like, at 20% of their long-term value, you can see that even in gold terms, the values of these metals, they're going to change upwards very, very substantially. So you've got the basis of a substantial bull market like in base metals, the result of their suppression basically by fiat currencies. Now, with the fiat currencies going down against gold as well, I mean, the place to be if you really want to diversify out of gold is in some of these base metals. And I think this sort of squeeze is really being reflected in particularly silver and also the platinum group metals. We're seeing it a bit in copper as well. And I think it's generally a very, very bullish story for commodities, because it's not just base metals. It goes wider into raw materials and also agri products and all the rest of it. The knock-on effect of that, of course, is that we will have unexpected inflation in 2026. I would think probably from about the middle of the year, you will see prices starting to rise very substantially. All they're talking about is, well, Trump's going to get interest rates down, so this is wonderful. Come on. This 60-40 thing is something that was really dreamt up by regulators. But if you actually think in terms of risk, where is the risk? Well, the risk is being in credit.
Yeah, absolutely.
So, I mean, it doesn't matter whether it's bonds, equities, or an IOU from someone else, whatever. It really doesn't matter. The thing is that the way in which you control your risk is you get into real money, which legally is gold and historically silver. So, what else do you do? That is the zero risk position. And I think that more and more people are going to wake up to this in the coming months. I think it's going to be as soon as that. I mean, I really do.
For the first time in decades, gold and silver are achieving true price discovery as physical delivery demands finally overwhelm paper suppression mechanisms. With record delivery volumes persisting for 16 consecutive months, large-scale institutional buyers are draining exchanges while the retail public remains largely oblivious. This lack of retail mania confirms the rally is not a bubble, but a calculated exodus from the dollar system by the world's most informed capital. Broader market data signals a massive inflationary pivot. As these raw materials inevitably reprice upwards to match gold's stable purchasing power, the global economy faces a wave of unexpected inflation arriving by mid-2026. In this environment, the traditional 60-40 portfolio offers no safety against credit risk, leaving physical ownership of gold and silver as the only mathematically sound zero-risk position. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.